Hey everybody. Now, I'm Tim Jenkins. I'm the chair of the Superannuation and Investments Practice Committee, and it's my pleasure today to introduce you to this session on capital management and reserving within superannuation. Now, what is it in a big room that everyone needs to go towards the back? You know, guys, this is your one chance, especially if you're walking in now, you can come, make it a bit more intimate for us. Come on. So please, think about that. Someone right at the very, very back, obviously multi-skilling. So please, guys, do it for you. Now, I'm going to introduce you to the presentation today and our speakers. We've got 3 speakers. We've got 2 sessions. So we've got 2 short, sharp sessions and a Q&A at the end. And when it comes to the Q&A, if you look at your pass, there's a QR code. If you scan that, the questions will go to my iPad over there I've just been given. And I will then choose the best questions to read out at the end for the last 15. So first presentation is from Tim Gorst. So Tim has over 25 years of financial services experience across both banking and wealth management, and he currently consults independently as a senior financial services and enterprise risk management actuary. So you see superannuation, control cycle, going further into all the other actuarial spheres. It's really important for topics like this. I've got Melinda here, a former CEO of the Actuaries Institute, for those of you who remember 10 plus years ago, if I can say that, amongst many other roles. And now a partner at KPMG for about 3 weeks? 4. There you go. 25% increase or whatever, 33% more than I thought. I won't go any further because if I keep introducing Melinda, the bio goes on for about 6 pages of all the things she's achieved. Melinda Howes, BT, now KPMG. And Michael Dermody, who's a partner in the actuarial and financial risk practice at KPMG Australia. If any of you are old AMPers, you might recognise Michael from 20-something years ago before you became a partner at KPMG there. And he did admit before that he used to be a defined benefit actuary, but he is now morphed, looking at much wider spheres. So with that, I'm going to sit back, pass to Tim Gorst, who's going to lead us through the first part of the presentation. And I might be rude, Tim, if it takes too long. I'll just tell you.
Cool.
Okay, cheers.
Look, I'm just incredibly excited right now to be in a room full of people who can say that OIFR excites them. I've spent my whole career sort of dealing with people who are not excited by it, trying to get them excited, having a lot of difficulty in that. But here I am. I'd love to spend the whole day with you, but unfortunately I'm going to be super quick. I'll talk for about 5 to 10 minutes, lay a little bit of a foundation for Melinda and Michael to give a very practical perspective on risk-based capital management, which I think is the topic which will go through the entire session. So first of all, I just want to thank a bunch of people. They're up on the screen, Tim included. Leandro, I saw you out there. Thank you, team, for being a part of the working group that has led to a research paper. I hope some of you have had a chance to look at that. If not, go into the Institute's website. But as a bunch of risk-based capital management practitioners, in my case, I've worked across life insurance, banking, and superannuation, so I've had the opportunity to see how that's applied across a number of different industries over the years. It was really great to come together, reflect on where the superannuation industry is now, 10 years after OIFR, and think about what can be done to go to next level on risk-based capital management, particularly through the lens now of member outcomes as a primary goal. So that research paper is available. I'm just going to give a very quick run through what some of the key insights that came out of that research paper, and then I'll pass it on to my colleagues here. Risk-based capital management, let's keep it really simple. It's activities that use the trustee and fund risk profile to inform appropriate levels and type of available or contingent sources of funding. So it's risk and understanding risks and risk profile on one hand, connecting it through to the funding that's needed to cover those risks. Remembering that anything that we do in super these days, we ultimately need to demonstrate a link through to member outcomes. How do we do that through risk-based capital management? It provides a more systematic approach to funding loss events or future strategic investment. And we can't forget about strategic investment. There's a lot of focus on capital to cover unexpected losses. It's probably the way we're all trained as actuaries, but right now there's a lot of strategic reasons for super funds to hold capital, and I know there'll be a bit more of that in the next few minutes on that topic. And strengthening the link and collaboration between risk, capital and reserve management capabilities. So these different capabilities, probably many of us who work in this industry, if you've had my experience, you've seen that there's quite a bit of fragmentation. We do have quite a structured risk management approach through SPS 220. The usual three-line players operate in that domain. ORFR strategy is probably the centrepiece of your modern super funds risk-based capital management strategy after SPS 114. In my experience, I've seen that particular responsibility passed between finance people, to risk people, to product people. Then it gets passed back to finance people. So it's one of those hot potatoes that tends to get passed around in terms of who does the work. Then you've got all your reserves within the RSEs, and there's the usual players there. And then you've obviously got some RSEL capital management, which probably 5-10 years ago wasn't as important, particularly if you're a not-for-profit. You know, you might have a company that's got very little in its balance sheet, but I'll make a couple of comments around why that's changing now. What is risk-based capital management? Well, it's a fairly simple aspiration for people like me who consult to a super fund is how can we get all of those different actors or tribes working together in their risk or capital management activities or reserve management activities to come up with ideas that are going to generate long-term member outcomes. What's the context for why I am here and why we pulled the working group together? And I remember Tim Jenkins and I, we've been talking about this topic for a couple of years, but we sort of 6 months ago, we thought, let's pull the trigger and get a working group and do a paper because we thought the timing was right. 5 things, super funds are growing. We know that, growing in systemic importance, and we know that APRA now talks about over 30 billion is systemically important if you're a super fund. There's quite a few super funds that are over 30 billion and probably more as we start to consolidate and the industry continues to grow. The Section 57 56 SIS Act changes were an important trigger for not-for-profits to start thinking about risk-based capital management, particularly in the trustee entity. Best financial interest duty, and Michael and Melinda will make some comments on that one. We've seen draft CPS 190 come through on the push for enhanced contingency planning. For no other reason that Tim and I were pulling this piece of work together with a broader working group. Draft CPS 190 came out and we're like, hey, this probably could be satisfied, this regulatory requirement, through an enhanced risk-based capital management approach. So we thought there was a synergy there around uplifting RBCM to cover not just ORFR, not just management of reserves, but also some of this emerging regulation. And finally, the APRA November 2021 discussion paper basically put out there to the industry that APRA saying that if you've got a financially resilient trustee entity, that is in the best interest of member outcomes. So when APRA says that, I think we should all say, well, how can we get a financially resilient trustee entity? And that's the link to RBCM. So that's some emerging context there. It won't be foreign to most of you. I just want to quickly say, if you go into our paper, there's a bunch of guiding principles. I'm not going to go through them because they're very self-evident, starting with long-term member outcome as the overriding principle that you're going to find in any trustee policy these days. Any trustee intent should be with that sole purpose. The one point that I will bring out is our paper pushes quite hard this concept of where are there opportunities to integrate across that fragmentation of risk or capital management. And prerequisites for success, again, I'm not going to go through these line by line, but there's a cryptic one down the bottom here, regulatory support. So maybe a little anecdote from me. I'm doing a little bit of support for a large for-profit entity, trustee entity that's asked me to help with their ORFR review. Nothing foreign about that. It's sometimes a little difficult, even if you jazz up your ORFR target review report to demonstrate that you're trying to create some really great links to risks and an understanding of risks, so all the stuff you'd like to see in an RBCM mature report. It's still a little difficult to get the client interested in having a really great in-depth discussion around how risk and capital, in the case OFR reserve, interact. And I think the reason for that is their reserves at 25 basis points. It's been 25 basis points for 8 years now. There's nothing they can do to make it any lower. They're busy doing other things. And so with that as the regulatory context, it's sometimes a little bit hard to get a client to step up to an aspiration of more mature risk-based capital management when they've got so many other things that they're doing. So I found that a challenge in this space. The reason I've put regulatory support as critical for success, without giving the ideas, there might be some things a regulator could do to make a client a bit more interested in spending more time and investing more money in risk-based capital management. So I'm just going to go through 4 really quick examples, again to leave time for Melinda and Michael. I just want to say that if you're a super fund thinking about what an integrated risk-based capital management framework might look like, the beauty of the actuarial profession is I think we've had a lot of experience in the life insurance industries, GI industries, health, with ICAP. Right? So as a working group, we actually went through ICAP and we're lucky enough to have a couple of life insurance practitioners on our working group. Thank you, Leandro, who helped us to just reflect on ICAP and say, well, can you reuse parts of ICAP if you're a super fund? And we came to the conclusion that in principle, yes, you can. Now, I'm not talking about ICAP becoming a regulatory requirement for super funds, but as a starting point, there's some good stuff in there for a super fund. So there's things that encourage you to have a really good understanding of your risks and a good understanding of your capital and reserves. By the way, if you want to jump into the research paper, we've got a bit of a resource for the profession there by giving a good long list of what that might look like for a super fund. But some of these other elements probably look familiar if you're from other industries, but we think that an RBCM framework should exist, that it should clearly articulate the policies and the regulations, and we know in superannuation there's multiple policies, OFR strategies, management reserve policies, capital and dividend policies, something that brings all of those things together, talks about a strategy for how those things are going to be used. That framework's going to be used to ensure that capital is adequate and reserves are adequate, whether they be for regulatory requirements or just non-regulatory meeting our risks requirements. The importance of data, monitoring and triggers, scenario analysis we think can be a real anchor, a backbone that brings everything together, particularly in the context of a data poor environment that we work in when it comes to tail risks. Review and reporting, and finally contingency and recovery planning, so that's a little bit of a placeholder for draft CPS 190 and 900. We threw this together as a starting point for what could be a possible risk-based capital management framework for a super fund that doesn't have one. We suspect a super fund will have all of these components but has not necessarily brought them together in an integrated way. A couple more examples that are brought out in the paper. We've probably all seen and been trained actually as actuaries around how to manage a PCR requirement when you're a life insurance company. We think the discussion is kind of there to think about an RSEL, so the trustee entity, as maybe having to manage capital in a similar way. Whether you're for-profit or not-for-profit, this is just an example. I know it's probably a bit more of a for-profit example where you've got an OFR reserve held at the RSEL. In this case, you've got some minimum working capital. I think the bit that is agnostic whether you're not-for-profit or for-profit is this non-OFR unexpected loss capital, particularly regulatory fines is the topical one, but there may be others. But certainly I think every single trustee in the country is starting to think, what's our internal capital target amount off the back of this unexpected loss, which is a large regulatory fine. So here's just a conceptual framework that probably borrows elements from other APRA-regulated industries, but uses superannuation context and laws. just moving on for my colleagues' sake here, we, as a working group, we like the idea of an annual RBCM report. So there's lots of RBCM reports that go through to a typical trustee. Is there a way to bring it all together as a more efficient use of a trustee's time, possibly working it in as part of a trustee's annual risk workshop? We just thought that's an idea that might sell, to a trustee as being more efficient, demonstrating integration, giving you an opportunity to get a seat at the table of the annual risk workshop. And at the same time, it could be a report that could satisfy the needs of your annual ORFR review as well, which I know is typically a separate report. So that we thought was an interesting idea that could be packaged up, and our paper gives a few ideas on how to pull that together. The final thing that I just want to talk about, which is in our report again, is the trustee regulatory fine contingency is something that we dwell into a little bit. We think CPS 190, if it comes into law, will have you doing lots of contingency planning. This example is for a trustee regulatory fine. One of the things that we put in the paper that might be a resource for you all is we give an example of how you might actually think about all of your actual and contingent sources of funding. Ask yourself, is that structure available for this particular scenario that I'm looking at, in this case a regulatory fine? Do some thinking around how might we conceptually prioritise those funding structures if this was to happen, and then actually use that ultimately to ask the question, do we have enough capital to be satisfied we're operating within our risk appetite if we were against the risk that we might get a large regulatory fine. So we've got some thinking there, and why that example is a good one is because this particular issue is quite topical, as we know, but as I said, CPS 190 might have you looking at not just this contingency, but a whole bunch of others to ensure you can satisfy CPS 190 if it indeed comes into law. So conclusion, I just want to say that I'm very optimistic of RBCM as being a really great opportunity for actuaries to show that they're ready to move beyond traditional actuarial work and into a new era of RBCM. I use the word facilitation because I don't think we go in and try to do what a lawyer's meant to do or do what a risk professional's meant to do, but I think the actuary is ideally qualified to facilitate across all those different stakeholders and to then ultimately package up the insights into that RBCM report that I mentioned before. So I think I'm certainly bullish on the opportunity to consult into that and create some really great member outcomes from that. Just a thought, if you're looking, what's a really simple next step? As I said, just get your ORFR target review that you do every year that might be starting to look a little stale, and see if you can just jazz it up by introducing some more risk-based capital management themes in there. And that might just be a little bit of a teaser to get an invite to do even a little bit more. I've certainly had some experience where they like that work and say, well, can you actually help us with some non-ORFR reserve management that we've got at the RSEL? So a little bit of a tip for how you can get things moving in a trustee without going in there. You don't have to go in with big bang. You can just little steps to get a trustee moving down the pathway of their RBCM journey. I've talked about an annual RBCM report as an idea that could be worth considering and pitching to a trustee. And finally, I know there's a lot of trustees out there and probably a lot of you that are being commissioned to help with Section 56, 57 regulatory fine challenges around what's that going to mean for how much capital we need to hold as a trustee entity. And I think that's another great opportunity to showcase and promote RBCM as a tool to help with that. So I'm going to pause there, try to be extra quick, pass it over to Melinda. Thank you.
Thanks, Tim, and hi, everyone. Well, this is an incredibly topical area, and Tim's just really outlined all of the reasons why. What we're presenting is some work that the KPMG team led by Michael Dermody, Leandro has been heavily involved, have been doing on this. And what we want to do is bust some common perceptions and myths, particularly around the risks to capital in super funds, but also some of the fundamentals like the purpose of holding capital. Why are we doing this in the first place? And if you think about holistic capital management, it really has regard to good capital management principles. And there are multiple purposes that capital is required for. And once you understand those purposes and the risks to capital, that really flows through then to what's the right policy to develop for the fund. And that lets you integrate capital management into your risk and strategy discussions. And the two key purposes for holding capital are to protect members from unexpected events, and particularly ones where you don't want to hit their member account balances, and also to fund strategic initiatives and things that are going to take more than maybe what's there in the working funds. So we're going to demonstrate how we've assisted some super funds to mature their thinking and embed that capital and risk consideration into their decision making. And particularly some of the approaches to performing the analysis to actually quantify the capital requirements. And as Tim's already mentioned, this has parallels in other industries. Life and general insurers do this. So I think that actuarial life insurance capability is really important here. So why is this topical? We've heard about the APRA review that's underway, and we put submissions in for that in March. And the ability to fund trustee penalties has been a really topical issue. But if you think about the environment super funds are in at the moment, it's really changing. There's a lot of mergers, there's changes to ownership structures, the emergence of mega funds, changing strategic objectives and fund operating models. And even just things like the retirement income covenant that super funds are doing a lot of thinking about at the moment, insourcing, rising customer expectations where they're expecting their super funds as they tip into pension phase to be acting like a bank and being a payments platform. They expect better digital services from their funds. In that background, I can understand why it can be challenging to get funds to really focus on this capital, but I guess the good news is the regulator's kind of making us do that. This is the paper that Tim mentioned, and they were seeking feedback on all those things. They're basically wanting to know, what are super funds doing and how is their thinking about capital maturing? And what I found interesting in this review was this part of the wording. They acknowledge that there's a variety of business models out there, but they really call attention to, and this is the core tenet, I guess, that super funds have to sign off every year that on the obligation that they've got adequate resources in place to run the fund. And part of those adequate resources is the capital they have at their disposal. And APRA are really calling out, what do you do, super fund, RSEL, when unexpected costs arise? Do you have the capital there to really get you through that unexpected event? Now, access to capital has been challenging and is becoming more challenging regardless of which different business models super funds are running. There's the issue in not-for-profits have had recently. There's a variety of approaches in the past in the not-for-profit sector. Some have built up significant capital reserves, others haven't yet and are now doing so. But there could be intergenerational issues on how quickly you build that capital up. And we know the issue of regulatory fines has been quite topical for some funds recently. In the for-profit space, and I used to run a for-profit fund, for-profits have tended to request capital for strategic initiatives annually from their parent in their business plan. However, as those funds are spun off out of well-funded parent companies, they're going to have to do really long-term strategic planning and forecast what capital they're going to require to be able to continue to invest in systems and do all their strategic initiatives. So I think those funds are going to be seeing increasing focus and pressure on this as well. We think there's been a lack of clarity on the purposes for capital and capital management. And the lack of those underlying principles has led to some of the comments like this that anyone who's been working in this space is probably familiar with, and Tim alluded to. Now, while it's understandable that some of these misconceptions exist, there are problems with each of these statements, and Michael's going to go into that in a bit more detail. not every super fund's struggling to understand this. There's a lot of funds who have matured their thinking around this. But the main point is we all need to move forward, the whole super industry, and really develop our thinking on this, because this is a fundamental governance issue for the funds, and super funds are fundamental now to our economy as a whole. So we've divided the purposes for requiring capital, and we've got assertive and defensive capital. We've got that concept from Carroll in 2011. And so we've got our operational capital over and above the ORFA, which we call defensive, and I've got some of the reasons you'd be holding that capital. Then we've got strategic defensive in the event the fund can no longer continue to operate and goes up into wind-up type of mode or merger mode. However, then we've got the more assertive funding for strategic or other initiatives. And for super funds, it's really important to understand and articulate the link between capital management and the fund and trustees' strategy and risk management framework, as Tim so eloquently pointed out. So if we take a step back and say, well, what are the principles for which we're holding capital? We know the purpose of capital for life insurance funds is, and we can really, I guess, draw a parallel here with super funds. So for insurers, this is to ensure, the capital's to ensure full payment of contractual benefits without the need for taxpayer or external funding. So drawing that parallel to super, on the left there, we've got a core purpose here for very low risk of members having their benefits immediately reduced because of a risk that we didn't expect to arise. And then on the strategic initiatives, there's a bit more judgment required here, but drawing a good principle we think to hold there would be to the trustees set their risk appetite for having insufficient capital to execute on their strategic initiatives, and particularly things that are going to cost more initially than the benefit to that members draw from that to start with. So with that, I'm going to hand over to Michael to go into a little bit more detail. Thank you.
Thanks, Melinda. And I've got a challenge. I've got 10 minutes to give you a lecture about how to calculate capital for superannuation funds. So, as Melinda said, we hold capital for three purposes. We hold them for operational risk to make sure we don't have a one-off event that we need to reduce members' benefits, number one. Number two, we hold them for strategic purposes. As a super fund, what initiatives can we undertake that are going to add more value to members than they cost? Number three, contingency planning, as APRA has alluded to. If things don't all pan out, our strategies don't work, we have to merge or close, can we affect that strategy, that defensive strategy, that exit strategy, without reducing members' benefits? Okay, so one element to the operational risk part, starting off with operational risk, the number one key thing is that we have got a lot of work the superannuation funds have already done around risk management. Most of them have got high quality second line risk functions, they've got risk registers, Tim talked about, risk incidents, they've got internal audit, they've invested a lot in that, so we need to leverage that. What actuaries are bringing to this operational risk assessment is actually the key focus on large and remote risks. That's where we need to add value to that operational risk assessment process. In terms of strategic initiatives, of course, the super funds, many of them have already done their short-term and long-term business plans. They've got expressions of appetite around, how much they're going to spend in each of those areas. Okay, so I'm going to talk more about those to the extent I've got time. One thing I do want to start off, this slide starts off with that risk appetite just to help to get you familiar with, operational risk losses. We need to, before we start the calculation, we actually need to understand the fund's risk appetite to these things. What is their appetite to having to hit members up as a big one-off because of operational risk event? What's their appetite for that? Okay, and then we get to the strategic initiatives. What's their appetite? What's their appetite for not having enough capital to do the enhancements, the improvements, maybe some of their more ambitious strategic initiatives? But we haven't got much time to get into any of that. One of the frameworks I'll talk about strategic initiatives is just, when I talk with trustees and executives of super funds, trying to divide that, you need a framework, you need to divide it into, obviously funds have got less ambitious BAU, compliance, reg reforms that might come on that might cost a lot of money. What are our enhancements? What's our ambition for our members? What do our members want? How costly are those initiatives going to be? Through to the more ambitious, new products, really leading the competition, maybe even in extremes getting outside of to adjacent industries, taking on big projects, insourcing, etc. And of course, inorganic strategies. I haven't got time to get into that, so I won't. But the point is, if you actually, as an actuary, and workshop these things, and you sit down with executives and trustees, they'll be very happy to share with you, and they should know, what's our ambition? Are we very ambitious about how we do things? Are we more in-source? We don't have the capability to, or the ambition to do really adventurous stuff. Okay. Now, back to calculating operational risk requirements. So this is how we do it. The first thing we need to do is we need to understand the complexity and scale of the superannuation funds activities. So we've got two parts. We've got to understand the scale, the complexity of their activities, and then we've got to understand the quality of the risk management, the quality of the operations, process controls around those activities. So I like to break the activities into these categories as sort of, it's not too detailed, you miss the wood for the trees, people can understand it. It's also how a lot of people will think about an operational risk event. They'll sort of think about these categories. Is it an administration error? Is it an error in insurance administration? I like to separate those two, don't put them together because they're quite different. Investment management, unit pricing, custody, financial advice. There's sort of some main activities everyone here can sort of get their head around. Then we start to think about what's the complexity of those operations. Start to think about, what's the number of divisions? What's the product design like? How many investment options? What's the complexity of all that? What are we outsourcing? Financial advice. Do we just do some small, simple stuff, intra-fund? Are we doing personal advice? What's the complexity of all of those things? And of course, lastly, the thing that most funds have done a decent amount of work on, and as I said, we need to leverage in our own work, is understanding the quality of those systems, process controls, and the quality of the risk management framework that goes across all of those activities. Okay, definitely haven't got time for this diagram, I don't think. But the point is, again, leveraging the existing risk management framework. Most super funds, decent ones, have done a good job. They've at an individual risk level, they've got identification, assessment, monitoring, controls, reporting. They've got 3 lines of defence models. Okay, what are actuaries adding? So what are we adding to that? What do we need to add to that? What we need to add to that is, first of all, a focus on systemic events. Events that happen at a member level aren't going to be big enough to 25 basis points, they need to be systemic events. The other big issue, of course, is that super funds don't have enough data, even large funds, and this is a big misperception that Melinda pointed to. Even large funds do not have an event history that is sufficient on which to model significant event losses. You need to look across the whole industry, you need to look to adjacent industries. Okay, then what actuaries need to do, and this is the actual job, this is the actual work, of course, is then scenarios and working, shopping with management. Some of those big events that have happened, those big unit pricing or financial advice errors, what can happen in our company, in our fund, workshopping with management. Haven't got time to go into that in a lot of detail. Okay, but one really good example I did want to touch on is, there's been a lot of criticism about this 25 basis points. It's too much, we don't need it. APRA, no one's accessing what's going on here. It's ridiculous. Okay, one good example just to reflect on, I think, for everyone to reflect on is an adjacent industry. I think about a life insurance investment linked fund. Life insurance investment linked fund has to have 25 basis points. Is a life insurance investment linked fund more or less risky than a super fund? It's a good question to ask yourself, I think. I think it's a good question. Why would a super fund be more risky? Number one, it's got insurance admin. Number two, it's got financial advice. Pretty risky things. On the other side, super funds might argue, and fair enough, might say, well, we're simpler, you guys had legacy, all this other stuff going on, risk management, not the same quality, don't want to take sides. Good thing to think about. Okay, don't have time for that. This is just, I guess, the types. Tim talked a little bit about this. I will say, obviously, scenario analysis is a big one. A lot of funds are already doing some of this stuff, so sort of plugging in and sort of understanding that. I guess some of that previous analysis can lead you to method number 5. So these are the methods people adopt. Method number 5, as well as scenario, is very popular. It's about saying, well, how complex and how well risk managed am I compared to APRA's sort of hypothetical, well risk managed fund. All right. I won't talk much about the strategic stuff because I do not have time. What I will say there is that the short-term ones are probably easy because they're already in super fund budgets. Any large super fund will have a budget. There could be new reg reforms, there could be competitor response, some working capital for stuff like that, but I'll generally understand it. For the longer term, that's more difficult, okay, and especially for not-for-profits. They don't, as Melinda said, if you're a for-profit, all the for-profits, if you've got a decent-sized parent or you're part of a group, you just do business plans, priorities, you submit it up the line, they say yes or no, you get the money if it's good enough, you don't if it's not. For not-for-profits, of course, it requires longer-term planning, okay? I don't have a parent I get money from. I need to think about what are some of those longer-term initiatives when we've advised funds. It's very important to think about, especially if you've got a fund that's got a lot and think of giving some back, what could come up? What are my ambitions? What realistically as a large project could I undertake? Okay, I will finish on my conclusion slide, okay, which is what do superannuation funds need to do now? What do we need to do better? It touches on some of Tim's points. We need to understand very clearly the multiple purposes for which capital is required. Okay, and I don't think that has been sort of very well understood. We need to mature also and embed in decision making, which is what Tim was getting at, mature capital management principles. Capital is the price of risk, okay? High capital is not inherently bad. That is not a bad thing. If you're going to undertake a more risky activity, okay, a good capital and business planning initiative and business case assessment process is to understand the capital that's required and the risk for that initiative. If we're going to take something in-house and we can add value to our members, that's fine. If it requires capital, that's good. We need to understand in terms of cost-benefit analysis, that's mature business decision-making. That's what needs to happen in our industry. And I think that's 10 minutes of how to do capital in a super fund. Yep, thanks, Tim.
Thank you, all speakers. Now, having looked at that, we didn't give everyone enough time, did we? There was an awful lot of stuff there. I felt like you were going at a pace there of the small print on those ads, which no one ever listens to. So all the slides are available for everyone afterwards. We may well choose to have an insight session on this further, I think. There's a lot to unpack in this. So thank you, guys. I've had a few questions through, so I'm going to try and group them if I can. One of the themes we've heard is mergers, and we've heard a lot about funds getting larger. So I've got two questions on that. I'm going to put both questions at the same time. You can choose which one you answer. One is, as funds merge and get larger, should it be okay to have an ORFR of less than 25 bips? That's the first question. The other one is, if you've got two funds not-for-profit merging, and their reserve levels are different, how do you cope with that as you put the funds together? So think about those, and maybe I'll start with Tim and we'll work along the line.
I think RBCM, in the thinking that I've done on it, entertains this concept of an internal target, and that sits alongside a regulatory target. And I absolutely think if a trustee, and I've personally experienced this, where a trustee feels hand on heart that I don't need 25 for ORFR under that definition. Now, by the way, it's a peculiar definition, SPS 114. It says even if you've got the best quality third party who's going to insure you for losses, suppliers who are absolutely bomb-proof, we want you to assume that you're operating in a world where, for whatever reason, they don't make good in a way that's timely. So it is quite punitive. People need to kind of remember it is a pretty punitive definition. But if you certainly felt it was less than 25, as a trustee, you should be saying our internal target or internal risk-based capital amount is less, albeit we need to hold the regulatory requirement. I think that will then have you sending the right risk-based capital signals throughout your business. On the issue of two super funds that have different ORFR targets coming together, I have had experience on that quite a while ago, but I just wonder if...
We'll pass over on that one then.
I'm going to keep passing it on to our resident expert
give him
here,
a chance.
Michael.
Okay, I think the 25 basis points is it's very interesting. I've had CFOs who've said, I think it's too high. Then I've presented them the sort of slide I just talked about, saying, well, in a modern Australian financial system, no member expects their balance to be reduced for risks that they didn't expect to be exposed to. Yes, they expected, if they invest in the balance, they do not expect to have their fund reduced by 75 or 100 basis points because, we had a fraud or a unit pricing error or something like that. And if you put that in the 1 in 200 type category, which the investment linked funds do, and you say, we should be stopping this from happening, and you say, well, we've got financial advice and insurance admin risks, and the industry has had, I've seen events that have been well over 10 basis points of a whole fund. You really have to think very disciplined. How sure are we? 25 basis point is not a massive amount. How sure are we that we can't have that happen? So I think that's what sort of needs a reflection. People shouldn't be expecting you to access the offer. It should be very rare. And there should be strength there. I think on the two super funds, I think one interesting thing about that, Tim, is that I think that has been a source of defraying some of these strategic initiative, costs. If you have one fund which has got a great admin system and another fund that's got something else, then that need for future strategic initiatives to improve that can reduce. I think that's been good for that purpose.
Thank you. All right, I've got an interesting question from the floor. This is about reserve levels. So an equity fund can lose 150 bips one day. It just goes up and down the market all the time. So if that's the case, why should we be so concerned about ORFR at 25 bips or 30 bips or 10 bips when markets move so quickly?
Yeah, and that comes back to the point I just made, Tim, that in this product, in every product that we advise people on, you need to understand the difference between risks they expect to be exposed to and the risks that they don't. And they're very, very different things. Very, very different. So it is unacceptable to really be having members have, I would think, the community would not expect, and and certainly in life insurance, we do not expect people to have account balances reduced for risks that members did not expect to be exposed to at a 1 in 200 level, at least. And that's plus, that's minimum.
Thank you, good answer there. Is it time to dust off the concept of a financial condition report? I'm saying that in the context that the Institute used to have a professional guidance note, which we retired last year on FCRs because no one was using them. Melinda, I know you championed this at the time, so maybe this is your stint as CEO,
past,
probably.
Yeah. I don't know if it would be the same sort of concept of an FCR, but what I think is really important in both what Tim and Michael spoke about is this holistic approach. And, we're now looking down the barrel of retirement income covenant and triennial reviews for that. So what is the mechanism for a super fund to have an annual process to say, have we got our strategy, our funding and our risk management? Because risk and strategy are just two sides of the same coin. Do we have that all lined up? What's our annual process? For all these different things, there's lots of different little bits. What's the holistic process and what's then maybe our triennial process as well? That seems to be a concept coming down the line. I think it would be good to have something like that, but there's so much change and so many different requirements hitting the funds at the moment that it is being looked at in quite a piecemeal way. I think bringing it together would be good.
The door is open, which probably means one last question, I suspect, although I haven't seen the note from the back, but I know we've hit the time. So what I'm going to ask you, this is actually about insurance. I think when we had the slides there, maybe some people are getting confused between insurance in super and trustee indemnity insurance. So I'm going to ask a latter question. What's the role of trustee indemnity insurance in this world of reserving and capital? Anyone want to take that one?
I can have a quick go. I think first of all, sometimes insurance has been a bit sort of overplayed. So to me, insurance is a necessary, like you've just got to have it, but then there's gaps and, missteps and the like. So you shouldn't count on insurance to provide everything, I guess is my point. But I have heard that sort of thing, again, this sort of, I outsource everything, so if it goes wrong I don't have to pay. I've got insurance, I don't have to pay. and that just doesn't really work in practice. I've seen lots of cases where, a fund did something wrong, or there was a mistake. It was maybe 5% the fund's fault and 95% the outsource provider's fault. And do you think that was the division of who paid for the mistake? Absolutely not. The fund paid for more of it. So it just doesn't work out perfectly. Yeah.
Thank you. Well, we're going to have to bring this to a close. It's a real shame because I think we could have gone on for another hour or so. I've been quite enjoying the discussion. So please, everyone, will you join me in thanking our presenters, Tim, Melinda and Michael, for the really interesting presentation on capital management and reserving in super. Lots of food for thought. Thank you.
Thanks, Tim. Excellent job.